Hey traders, Andrew Keen from AlphaShark.com. Today's trading tip of the day is you got to know when to hold them, and then you got to know when to fold them. What happens a lot when we trade and we see institutional orders in call options per se, so if the initiator is buying calls, right, the market maker or the firm that is selling calls, how do they hedge themselves? I know because I was a market maker. I would buy stock against my calls. Okay? So market makers hedge themselves. Speculators are speculating. So we saw an institutional order here in MGM, the 21.5 calls, and I didn't take a trade on this, so there's no gains or losses on this trade. And the stock spiked up really quickly. And I said to my subscribers, said, hey, I would probably be out of the trade. You see the market starting to sell off here. So let's just look at the signal here. And we always say it's important to get on the plane, but it's much more important to get off the plane. So MGM here, institutional order flow of the 21.5s. Let's go back up. So the 21.5s we see here traded 33 cents. Okay, where did MGM go? MGM has sold off 2% from the highs. Okay, so I said to my subscribers, hey, you got to know when to fold them. Okay, got that initial spike, looked like it was stalling out. Let's get on a 5-minute bar. And so spiked higher, guys, and then you see that big tail on top. Okay, so spiked higher, and you see that big tail on top. That tail on the top could be a complete reversal bar. So putting on entries is great, but you got to know when to take it off. Okay, reversals, candlesticks tells everything in trading. Okay, everything's just a supply-demand curve in trading. So today's trading tip of the day is you got to know when to hold them and also know when to fold them, realizing, guys, that exits are actually more important than entries. Thanks, guys, and we'll run it back tomorrow.